here's an interesting chart. So, there's many ways to invest, obviously. And this is a chart that came up, and I thought this was pretty, Friday was a pretty decent down day for the NASDAQ. The Dow was and S&P were all down. The NASDAQ, I think, lost 3% alone on Friday. So, investing is usually, the escalator on the way up, so you kind of climb on the way up, and then on the way down, it's the elevator, right? So you're kind of going sharp on the way down. But those uptrends usually outlast the downtrends, and that's why you kind of, you get these, over time you're earning more, et cetera, and then you're losing, and it ends up being a profitable venture. But here's an interesting chart just to kind of show you, what different investment experiences can look like. So, you know, a 10-year return, 5.4%. Let's just say you bought a bond or a CD at 5.4%. You owned it for 10 years. You made 5.4% on your investments. And then you have scenarios 1 through 5 with different investment returns. So scenario 1, you averaged 8% a year through the first 9 years. And then the last year you lost 15%. That annualized you out at a 5.4% return. The interesting part here is, let's look at the scenario 4, where you're really knocking it out of the park, right? Or even scenario 3, to be honest with you. You're knocking it out of the park, 20% return, 20% return. What do you have? 7, 8 years of this. But in year 9, you lose 0.25%. Year 10, you lose 48%. Those two big hits, completely erase, the majority of the returns, the knocking it out of the park of 20% returns the first 8 years, and knock you back down to this 5.4%. In similar scenarios in scenario 5, or the same story in scenario 3, you're getting 14% a year for 9 years, and then you have a bad year, right? You're knocking it out of the park. And when I say a bad year, let's look back, 07, market was down 57%. 2000 was a 2.5 year decline, but the market was down 49%. So not out of the realm. If you've talked to me about investing, I've probably told you, anything you own in stocks is potentially at risk for a 50% loss in a bad environment. That's an '08 environment, the Great Recession, stocks lost 50+%. That's a 2000 environment, where 2000, 2001, 2002 was a 3-year loss in stocks, which compounded to be a total of about a 49% decline in stocks. So not out of the picture. I know people get comfortable with, the current environment and returns being up, and any loss we have is, made up in 3 to 6 months, and we're back to new highs. But you can see here, a 14-year return, for 9 years, and then you get a bad year, and that wipes you back down to the 5.4% annual. So those losses, there's a lot to be said about preserving, right? And kind of staying steady, Eddie, and not really shooting for the high risk and high return, because if you get it, on the downside, which is impossible to predict with any amount of skill, you run into this environment, it really kind of mitigates all those, prior year returns.